Tariffs are at their root taxes, and I believe that taxes are bad, so I'm anti-tariff. I realize that other nations employ tariffs. I read a post on social media that say 170 governments worldwide impose tariffs. How can tariffs be a bad thing? Well, 170 countries worldwide are wrong. Governments love tax, and taxes are pernicious. If we actually wanted to become more competitive as a country, we should alter our tax code to make our tax code more investment friendly and less consumption friendly. As an example, Trump's chief concern seems to be with China right now. If I went to build a factory in China right now as a foreign investor, and that construction technique was tilt-up concrete, the predominant form of construction for a factory, I could expense my production costs against current income and take those tax laws carried forward as far as I needed them to. In the United States, I would amortize that construction expense over 30 years, which is to say I could reduce my income by about 3.3% a year for 30 years, as opposed to expensing them in China. If we really want to make the US more competitive, it would be reasonably easy to do. All you need to do is make the tax code and the regulatory framework more investment friendly than consumption friendly. That would appear to be a task that's too hard for American voters. They would prefer to address their shortcomings by attacking others. It is interesting, like other politicians, that he seems to talk out of both sides of his mouth. He talks about making government smaller at the same time that he urges Congress to pass a continuing resolution to increase the debt ceiling and deliver the third or fourth or fifth largest quarterly deficit in history. Those two facts seem to be incongruous together. I guess I'll have to wait. I would recommend to your listeners a wonderful book about this process. The book is called The Triumph of Politics. It was written by David Stockman. David Stockman presided over the Office of Management and Budget in the Reagan years. You may remember that Reagan won the election by a landslide, not by the narrow margin that Trump did. And there was a national mandate to reduce the size of government. That mandate was derailed by Congress, both Democrats and Republican, within 6 months of Mr. Reagan's inauguration. So if you're looking at how this administration might reduce debt, deficits, and government spending, it's important to look at what they did in terms of the recent budget and the continuing resolution. And it's also important, I think, to look at the history of the last major effort that we had to reform our government, which was sadly very unsuccessful. The problems are very large. The on-balance sheet liabilities of the federal government, which is to say what we owe each other and other people, the bondholders, exceeds $36 trillion, or $30 trillion net of the Fed's own balance sheet. That's a pretty big problem when you think about that gross government revenues before any expenditures are $5 trillion. But a bigger problem is the off-balance sheet liabilities. The net present value of unfunded government promises, things like Medicare, Medicaid, Social Security, military pensions, federal government pensions, the Environmental Trust Fund, exceed, according to the Congressional Budget Office, $100 trillion. That's at the federal level, before state, local, corporate, and individual debt. If you add the on-balance sheet liabilities to the off-balance sheet liabilities of the United States government, what you find out is that at the federal level, we're $130 billion in net indebtedness. That, in turn, is problematic when you look at the aggregate net worth of American people. The Internal Revenue Service, who makes it their business to know what you're worth, suggests that the aggregate net worth, private net worth of American citizens is $141 trillion. And of that, $130 trillion is pledged. This is the nature of the problem. My suspicion, which will tie this back to investments and finance, is that the way that we deal with this program is, yes, we finesse some of the net present value. We raise the entitlement age for Social Security, stuff like that. But that really doesn't matter. What we do as a society is what we did in the decade of the 1970s. We debase the currency. We reduce the purchasing power of our obligations so that we honor our obligations in a nominal sense, but not in a real sense. The Office of Management and Budget suggests to us that in the decade 1970 to 1971, the purchasing power of the US dollar was reduced by 75%, which means that $1,000 of savings in 1980 bought $250 worth of goods in 1971 prices. It is not coincidental that during a period when the purchasing power of the US dollar declined by 75%, that the gold price increased 30-fold. I'm not suggesting that the gold price will go up 30-fold from here, but I am suggesting that in the next 10 years, the purchasing power of the US dollar, in terms of devaluing our debts, will go down by 75%. And I suspect that assets that have traditionally done well during periods of time when the purchasing power was under fire will do well. And I suggest that gold is one of those assets. I'm not suggesting, by the way, that the things are hopeless. Things aren't hopeless. We'll get through this. We will have a reckoning. Those people who make hard choices now and prepare will come through better than other people. But you do have to act. If you are a younger person and you believe that you are entitled to the type of retirement that you have been promised by your government, you need to think again. You need to prepare for your own retirement. You need to begin saving now, systematically. You need to live below your means. You have to store some of your savings in investments or in asset classes that traditionally have done well during periods of time when fiat currencies were debased. You have to learn from history, and you have to apply yourself now to protect yourself for this reckoning I think you need to assume will occur as a consequence of the arithmetic around our debt and deficits. There were two broad asset classes that did well in the decade of the 70s. One was public companies that had dominant enough products or market share that they could raise their prices to keep pace with inflation. It's worthy to note that Warren Buffett, through the decade of the 70s, generated 25% compound annual internal rate of returns. Not following fads, but rather owning things like American Express, Coca-Cola, See's Candies, businesses that were fairly mundane, but that had products and services that were valuable enough to consumers that consumers were willing to stomach price increases that were commensurate with the rate of inflation. The other asset class, which works very broadly well in periods of inflation, are natural resources, but particularly precious metals. If you look back at the decade of the 70s, the copper price went from 30 cents a pound to $1.50 a pound. The oil price went from $3 a barrel to $25 a barrel. The price of decontrolled natural gas went from 30 cents a million BTU to $12 or $13 per million BTU. Not coincidentally, the gold price went from $35 to some number like $800 or $850. The broad range of resources did well. What did poorly? Long bonds, something where your yield is frozen, but inflation eats up the net present value of that yield over time, really murders you. At the beginning of the decade of the 1970s, I think the prime interest rate was like 5.5. At the end of the decade, it was 15.5 or 16. What that means for somebody who owns a 30-year bond is that the purchasing power of their bond coupons is a quarter of what it was at the beginning of the decade. And the principal value of the bond falls substantially as well. The truth is, we all live in this world. We all need to take advantage of every tool that we possibly can to lower our production costs and to make ourselves more efficient. What this means on an individual worker's basis is that worker is going to have to reinvest in his or her knowledge base. Rather than being put out of business by AI, they're going to have to learn how to employ AI to make themselves more efficient and to increase the output per hour they work. That's where wage increases come from. I think as individuals, we've preferred to believe lies as opposed to prepare ourselves. And I think our government found themselves being easily elected if they continued to lie to us. The reckoning is coming home. From an investment viewpoint, how do we build heavy industry in the United States where we allow capital investments to be amortized over 30 years, and the Swedes and the Russians and the Japanese and the Koreans and the Chinese expense them? Think that through. Think the cost of capital. To the extent that we're going to become competitive, we have to become competitive. You don't become more competitive by making the other people artificially less competitive. That's not the way the world works. You can't get around arithmetic. If you are going to have manufacturing jobs, you have to have the capital equipment that supports them. And you can't have the capital equipment flowing into the US when that money is treated better elsewhere. It doesn't work that way. Money goes where it's treated best. Gold has done well traditionally when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. Let's look at the math. Although the government would have you believe that the deterioration of the US dollar is only 2.6% compounded, that's the CPI, or as I like to call it, the CP lie, common sense says that the deterioration of your dollar is much higher. First of all, the CPI doesn't include tax. And I guess if I didn't have to pay the tax, I wouldn't complain so much about the index. I believe that if your listeners conducted a common sense thought experiment, they could challenge the CPI easily. Put together a basket of goods and services that you used in 2020 and still use today. Your car, gasoline, rent or mortgages, health insurance, health care, groceries. What you will learn by constructing your own basket of goods and services is that the purchasing power of your savings is declining by more like 7.5% or 8% a year than 2.5 or 2.6 a year. Now, let's put that in the context of your savings. The world's premier saving instrument, the one that everyone else is priced against, is the US 10-year Treasury, the world's benchmark Treasury. Using it as a proxy for savings, if somebody buys the US 10-year Treasury today, the US government solemnly swears to pay them, 4.5% or something like that, in a currency where their purchasing power is declining by 7.5% a year, which is to say, if you save money and you loan it to the US government, it will cost you 3% a year compounded for 10 years. In 10 years, they will give you back about 60% of the purchasing power that you gave them now. What could make you more nervous about the maintenance of the purchasing power of your savings than a government guarantee that they were going to cost you 40% of those savings over 10 years. If history is prologue, the current rate of the deterioration of the purchasing power of the US dollar relative to the yield that is commonly available to savers almost guarantees that the gold price continues to do well. This performance in the gold price, while it's become more noticeable of late, has been going on for a very, very long time. When people in these interviews said to me a year ago, Rick, when is the gold price going to finally move? I would say, I think it's going to finally move beginning in the year 2000. In 2000, the gold price was $250 an ounce. Now it's $3,000 an ounce. Gold is up 8.5% or 9% compounded for 25 years. Gold has been maintaining its purchasing power while the purchasing power of the dollar has been deteriorating, and it's done so for 25 years. Precious metals bull markets are led by gold. They're led by the fear buyer. When the momentum, the price momentum in gold becomes noticeable to the generalist investor, perhaps because of its lower unit cost, silver begins to outperform gold. We haven't seen that occur yet, and I'm not actually really sure why it happens. I've just noticed that in 3 prior bull markets, it has happened. I think from the point of view of platinum and palladium, that they are cheap, not merely relative to gold or silver, but relative to a basket of commodities, and in particular relative to the utility that they command as industrial materials. And I think that they will do well over time. But I believe gold right now will maintain its leadership role. Oil and more recently copper seems to be suggesting to us that investors are afraid of a recession. Certainly oil responds to immediate rather than longer term economic pessimism. And it could be that on a global basis, we're experiencing an economic slowdown. That's what the oil price would seem to suggest. Looking longer term, the increase in oil production was largely a function of one country, the United States. And my nervousness as a U.S. oil investor is that most of the increase in production that we've seen in the United States is a consequence both of a very low cost of capital for American producers, but more importantly, the conjunction of various new exploration and production technologies. That production growth, particularly in the Permian Basin of the United States, would seem to be slowing, which is to say the industry believes that in terms of their grade A undeveloped locations, that they've drilled about 85% of their inventory, so they have 15% less to drill. The attractiveness of those locations left to drill is a function A of the technology, so if technology improves, that number could increase, but also the cost of capital, and interest rates are rising, and the price of oil, and the price of oil is falling. One could expect with the diminished number of grade A locations and the increasing cost of capital and the decreasing oil price, that the ability of the United States to continue to supply the oil and gas that the world needs in transition is declining. And the consequence of that is that I think you see oil prices in 2 or 3 years, not merely higher, but probably substantially higher than they are today.